Hi, it's Jared here from Beyond Accountancy. The purpose of this video is to talk about the upcoming changes to trusts and what you might want to do or not do if you currently use a trust as part of your business or investment affairs. This is a rehashing of the segment in our budget response video about trusts. If you're at that webinar, you probably don't need to watch this video as well. So what we're going to try and cover in this brief video is what's changing with trusts, what still works and what doesn't work, timing issues, and what are my other options. So the key change is that the government has introduced the idea that we've not had in the tax system before of minimum tax rates. So if you're a discretionary trust, you'll pay 30% tax on your income. So the trust will pay the tax instead of the beneficiaries like it is now. When the beneficiaries receive that income, it goes in their tax return and they get a credit for the tax, but it's not a refundable credit. So what that means is if you're in the bottom two tax brackets where your tax rate in 2029 will otherwise be 0% or 16%, that doesn't matter. If you have a tax on a capital gain or tax on trust profits, then you'll pay 30% tax, even though your other tax is lower than 30. So it's essentially increasing taxes, but only on one type of income, which is really strange. So fixed trusts and super funds, which are technically trusts, and widely held trusts, like say listed companies like Goodman Group or Transurban, they're fine. The target is private family wealth, which deliberately or not targets small and medium businesses and mum and dad investors, unfortunately. So what works and what doesn't work? So if you're distributing from a trust, a discretionary trust, to middle and high income earners, and by that I mean people whose other income, so income apart from the trust, is already more than 45,000, then you're not impacted, because for those people, as we saw in the table, their tax rate is already 30% or more from 45 grand onwards. If your trust is distributing to a low income earner or distributing to a corporate beneficiary, what's also called a bucket company in the trade, then the tax is significantly worse. So if we took an example of a mum and dad business making 120 grand profit, say a fish and chip shop or a small service business or whatever it might be, and they can split their income 50-50, the tax rates on their share of profit, so 60,000 each, if that comes from a partnership, it's $19,000. If it comes from a company, it's $19,000. But if it comes from a trust, it's $36,000. So the really strange thing about that is it's the same business, the same owners, they have the same profit, they have the same wealth, but their tax is almost double. But one simple way around this, if it is a trading business, and mum and dad are equally working in the business, or they're doing enough work, enough hours to justify a $60,000 wage, then they'll actually pay slightly less tax because of the tax cuts on the very small tax cuts, but there have been tax cuts on wages announced in the budget. So if you run a business through a trust and you're actually working in the trust, you can pay wages to avoid these high rates of tax. You can't pay wages for someone who's not working in the business, or you can't pay a $60,000 wage for someone doing $20,000 of work. So it's not foolproof, but that is one way of reducing the tax. So should you close your trust? If you have a discretionary trust, should you close that down and replace it with something else, or just run your business or hold your assets, depending if it's a business trust or an investment trust? Just have that in your own names? Maybe, but don't do anything about it now for two reasons. One, this is not law yet, so you'd be jumping the gun to do anything drastic now. And two, there's a restructure rollover. So a rollover is where you get to change from being a trust to some other structure without triggering capital gains tax or any other tax consequences of that change of structure. So if you went from a trust, so you sold all your assets and moved them into a company, you have to pay capital gains tax on all those sales. With a rollover, you move the assets to the company and that capital gains tax doesn't apply. So basically a rollover gives you more options of how to get rid of your trust. If you think about the timing of things from budget night to the end of financial year that's coming in 2 weeks' time, nothing really changes. You can see that the minimum tax rate comes in July 2028, so that's the 2029 financial year. But the ability to roll over, so to improve your structure tax-free, starts a year before that. So when would I look at changing my situation? Maybe reevaluating my discretionary trust, closing it down. It'll be just before the rollover starts. So if you do decide to change structure, you could do it on a nice, neat date of 1st of July 2027. That's when I would change things. And what would be the alternative structures? Well, excuse me. Holding investments through a company. So in the old, because we've had trust changes, we've also had CGT changes. In the old CGT rules, without going into detail, a company had the worst rate of capital gains tax of any structure. Company, trust, partnership, super fund, whatever, company was the worst. Now, with a 30% minimum tax rate, company is the best or the equal best structure for holding CGT assets outside of super. So super is the best, but because of the age restrictions, it's not always appropriate. So let's say we have a company. How can we use a company in a similar way to a trust where we don't have to pay out everybody equally every year? We could use a trust, so we could use a company with multiple classes of investments. So you might have a mum and dad and 2 kids. You have ordinary shares. So these are the shares that control the capital and control the voting rights. And mum and dad own those shares because that way they can hold the control of the company. They can share some of the profits with other members of the family, but they don't have to give away control of the actual assets. And you could decide to distribute to your son in 1 year, but not your daughter, or your daughter in 1 year and not your son, depending on their requirements for income and depending on your wishes. So that's a potential structure we might use in the future. For now, let's see what the ATO does in response to that. That's an idea that the profession came up with almost straight away when the rules came out. Will the ATO then try and make new rules to stop that from happening? Who knows? But there are definitely other ways of holding assets if you've got an investment trust, and other ways of running a business if you've got a business trust or a trading trust, we might call it. So what's our summary? You are impacted if you use a discretionary trust. If you've got a unit trust or a super fund, which is technically a trust, then don't worry about it at all. The impact is particularly true for investment trust because if you're running a business, you can pay yourself a wage without having the 30% tax. But for an investment trust, it's hard to justify how much wage you could get just for checking the share portfolio and managing the rental property. But if all your trust beneficiaries, even if you have a discretionary trust and it's an investment trust, if all your beneficiaries have incomes over 45,000, you're not impacted by minimum tax rates. Your tax rate is already equal to or worse than 30. So the new change does not impact you. The new changes are targeting low income earners. So what's our action for now? As of this month, wait and see, because the rules start in 2028. You've got a year before that where the rollover period starts. So wait a year before you do anything. I hope that's helpful. If you have any specific questions about your trust, feel free to get in touch. Thanks for your time.